Hello and welcome. I am Katherine Studley, founder of the only consultant in Prisma Tax Group. You are receiving this video because you showed interest in joining a free webinar that we hosted a couple weeks ago about US tax and what it's like to work with a US accounting firm. So thank you very much for showing up. I wanted to stay connected and deliver on my promise to provide free lessons on US tax basics. So, as a little update, we are developing a full educational course with certificates for Filipino VAs covering US tax fundamentals and best practices overall for working as a virtual assistant. So, this lesson is just a preview of what is to come. So, I hope that it helps you build a valuable skill for working with American clients. Let's get into it. So, this is a lesson about types of earners and filing statuses. The thing about US tax is that it can be complex and there's a lot of moving parts to it. So, this is a very high level explanation. So, first of all, what type of earner are you, or what types of earner exist? You should understand how the income is earned because that directly affects what it means for your tax situation. And it is possible to be a hybrid as well. So, the most common type of earner is an employee. So, this means that you have an employer, you punch a clock. The tax document that you would receive as an American when you are employee is called a W-2. And there is federal tax on that and potentially state tax withheld from every paycheck. The state tax depends because not every state has state tax. And withholding is what your employer is keeping, basically. They're helping you prepay your tax to the IRS. So that's why sometimes if you're an employee, you'll get a full refund when you file your tax returns. That's because your employer withheld more tax than they really needed to, but it's your money that they're withholding. So you get it back as a refund. And there's a form called a W-4 where you can adjust your withholding if you need it to be higher or lower, depending on the rest of your tax situation. So you receive a W-2, that's the wage document, and a form W-4 is what you fill out ahead of receiving the W-2, like when you first start the job. Okay, now things get a little bit more interesting. So, a sole proprietor is the moment you start earning self employment income. So, that's like cash or a 1099 NEC. That means that nothing is withheld. You are a sole proprietor by default. So, you're likely issued a 1099 NEC. The NEC stands for non employee compensation. So, instead of giving a W 4, when you start an engagement, when you start working, you will complete Form W-9. And people are completing this form with their basic information, name, address, phone number, social security number. And these get issued with the IRS, our federal tax agency, and then also the taxpayer themselves. So if someone is working as an assistant here on a contract basis, this is what they would be considered. Um, when you are a sole proprietor, you should always start a separate bank account. Since you have no business entity, like no structure, you can use a separate personal checking account as long as the business income and transactions are isolated. And we're going to, this is something that we would talk much more about. Follow me on social media because I talk about this almost every day. Okay, single member LLCs. This is a very hot topic. As a single member LLC, your tax treatment is exactly the same as a sole proprietor's. And I'm going to say that again because this is a huge misconception. An LLC does not change your tax situation. It does not equal any tax savings. You are still allowed to take write-offs. They're exactly the same as if you were a sole proprietor. However, now you have a limited liability protection because you have an actual business structure. So that means that you can do business in an EIN number instead of your social security number. So if you have an LLC when you're completing the W-9 before receiving a 1099, you put your LLC information on there. And an EIN number is basically like a social security number for your business. That's what people use to open up a bank account. An LLC is a limited liability company. So it's basically a business structure that offers limited liability protection and pass through entity taxation. So, as with corporations, the LLC legally exists as a separate entity away from its owners. So, you basically have a line between your business assets and your personal assets. If you were to go bankrupt or be sued. And there's, again, a lot more to talk about when it comes to LLCs. You should know they exist. It's a separate entity and it goes by state. You get a federal tax filing number, but the LLC is formed in the states themselves. Moving into tax filing statuses, we have a few options here: single, married filing joint, married filing separately, head of household, qualifying widow. Your filing status is especially important because it determines, in part, the tax rate that you are actually taxed at, the amount of your standard deductions, which we'll talk about in a second, and then which types of credits are available to you. This has nothing to do with being self-employed or an employee. This is just like from the top, these are the options as an American taxpayer. So you'll hear people talk about like getting married for the tax breaks. They're talking about the potential benefits that would exist when you file in a different status. Claiming a dependent. So this isn't as simple as just declaring someone your dependent and then taking them on your tax return. There is a tax break, but for tax purposes, a dependent is someone other than the taxpayer or spouse who qualifies to be claimed by someone else on that tax return. So generally, a dependent is someone who relies on another person for financial support, housing, clothing, necessities. Usually, this is going to be children, and there's a lot of rules to this too. But it could also be other relatives, could be your parents, it could even be a boyfriend or girlfriend. But once you get married, you're not allowed to claim them because you're filing the tax return with them. So, in order to claim another person as a dependent, they have to be a US citizen, US national, US resident. They can also be a resident of Mexico or Canada. And it's important to note that a dependent can file their own tax return, but is not able to claim themselves. Standard deduction versus itemized deductions. So the federal government gives you free money for existing. That's called the standard deduction. So this chart is for 2025 tax year. These numbers do slightly change from year to year based on inflation, but there is the standard deduction and itemized deduction. And again, this is for every US taxpayer. This has nothing to do with being self-employed or being an employee. But the standard deduction lowers your income by a fixed amount. Okay. And they're based on your filing statuses. Where on the other hand, itemized deductions are made up of a list of eligible expenses. And you can claim whichever of the two lowers your tax bill the most. The tax law changed in 2017 on this and made it very, very difficult for taxpayers to itemize. So in our practice, we have very few people who are itemizing on Schedule A. And basically, that's a list of very specific deductions: medical expenses, mortgage interest, state and local tax. Again, it gets complicated. In a perfect world, if you could somehow add up all of these deductions on Schedule A, and if they are higher than these flat rates that the US government gives you just for existing, then you can take one of those. All right. Thank you so much for watching this very quick presentation. I hope you found the information valuable. We are working to build out our websites and socials for our upcoming education course. But I did just want to show you where you can find me in the meantime. So you can find me on social media platforms. Katherine Studley. I'm on LinkedIn, Instagram, TikTok, Twitter. This is my Instagram and TikTok handle. This is the brand. This is like my brand, and this is like the tax firm. So, again, thank you so much for joining. I hope this was helpful to you, and be on the lookout for more emails from us. Thank you.